Welcome back to the deep dive. You know, if you've ever looked at financial markets, trading strategies, it can feel like just information overload, right?
Yeah.
So much jargon.
Yeah, absolutely. Indicators, noise. It's a
Yeah,
lot.
it really is. But our sources today, they lay out something quite specific, a repeatable method that tries to cut through that. It's called candle range theory, or CRT.
That's right. And our goal here really is to boil this down, to synthesize the core parts of this system.
Hmm.
It's a framework that it forces you to be patient, be precise,
Okay.
focusing only on what it sees as these high probability setups, mostly on the daily and the 4-hour charts.
So filtering out the noise.
Exactly. We're going to look at three main trade patterns.
Ah.
The 3x3 reversal, something called ATR momentum, and a continuation setup. But just as important, maybe even more so, is the risk management,
Yes.
the art of the pyramid. We have to cover that.
Right. The knowledge seems very specific, but the aim seems universal, doesn't it?
Yeah,
Teaching you how to spot when a strong trend might be, well, running out of steam.
And how to trade that reversal.
And it all revolves around using the range of certain strong candles as your, like, main trading zone.
Precisely. It's about context, and it's about seeing decisive action in the market.
Okay, so let's dive into the foundation then. The main setup. The 3x3 reversal. This whole idea is built on the fact that, well, price can't just go in one direction forever.
Exactly. Nothing goes straight up or straight down indefinitely.
So how does this candle range theory, how does it define that moment when momentum might actually be exhausted?
Okay, so it's quite strict. It demands a few things before you even think about an entry. First, you need to spot 3 strong consecutive candles.
Daily or 4-hour charts?
Either one, daily or 4-hour. And they have to be moving decisively, one way. Second, and it's really important, each candle has to make a new high if it's an uptrend or a new low if it's a downtrend.
Okay, so sequential new highs or lows.
Yes. And the sources, they really stress this point.
Mm-hmm.
It's not about finding 3 tiny little sort of hesitant candles. They want to see speed, strength.
Right, so it has to be 3 strong, decisive moves. Proof that the momentum is still pushing hard. But, hang on, why would you look for a reversal right then, when momentum looks strongest? Isn't that like stepping in front of a train?
Yeah, it feels like it, doesn't it? But that's sort of the core idea. It's counterintuitive maybe, but it's very mechanical.
Okay.
That third candle, the one that makes the final new high or low, the one confirming peak momentum, that specific candle becomes your key range candle.
The range candle.
Yes, that sets the boundaries for your potential trade.
Mm-hmm.
The thinking is that this final burst of strength, it's often the last grab for liquidity. It pulls in the last group of traders who think, okay, this trend is definitely continuing.
I see. So the entry is based on setting a trap, essentially. How does that trap get sprung?
Well, the entry trigger is designed to confirm that the market really has run out of gas. First, the price has to do what they call a raid. A raid. Yeah, it needs to sweep decisively above the high of that range candle, or below its low. This move, this spike, it basically traps those last breakout traders who jumped in thinking the trend would keep going.
Okay, I can picture that spike where everyone thinks, yes, it's breaking out.
Exactly that moment. But the actual trade trigger only happens when a later candle, specifically on the 5-minute chart, they call it the money candle.
Money candle, okay.
When that candle closes back inside the range of that third main candle.
Okay, so it spikes out, fails, and then snaps back inside.
Precisely. Think of the range like a zone. Price gets pushed out violently, but then it gets sucked right back in. That close back inside confirms the exhaustion. It confirms the reversal is likely starting.
And when this works, when the reversal holds, the trade is supposed to be quick.
Yeah. Ideally, you're looking to be in and out within maybe 1 or 2 of the next candles on that higher time frame, the daily or the 4-hour.
And the target, where do you aim to take profit?
The safest bet, according to the sources, the primary take profit goal is the 50% midpoint of that range candle.
The halfway point? Why specifically 50%? Any reason?
It seems to be because that 50% level often acts as a kind of psychological midpoint, maybe a high volume area where price often pauses or consolidates before its next big move.
Okay, that makes sense.
So presented as a reliable target, it maximizes the chance of getting a quick win while minimizing how long you're exposed to risk. The examples they give show potential for 130, maybe 157 pips pretty quickly when it works out.
That's a decent move, a quick strike. Now, there's a critical risk point here, right? That 5-minute money candle. It's low if you're buying, or it's high if selling is key.
Absolutely crucial. If price closes back inside the range, you enter. But if price then turns around and sweeps below the low of that money candle for a long, the whole idea is invalidated.
So you get out immediately.
Immediately. The trade setup failed, the trap didn't hold, you were wrong about the exhaustion, cut the loss small. The risk control is built right into how you enter.
Okay, that 3x3 reversal is clear. It's the core discipline, it seems. But once we get that reversal idea, where else does the system look? You mentioned momentum context.
Right. That brings us to the second type, the daily APR momentum trades. And what's interesting here is how they add another layer. They use the basic CRT structure, but filter it using volatility, specifically the average true range, or ATR.
ATR. Just to remind everyone, that basically measures the average size of recent price moves, like in pips or points.
Correct. So if a currency pair usually moves, say, 50 pips a day on average, and then one day it suddenly prints a huge 75 pip candle, well, that's an above average ATR candle.
A volatility expansion.
Exactly. But they don't just look for these big candles anywhere. This is where the filtering is key. They're only interested if that big ATR candle happens outside of important weekly levels.
Which levels?
Specifically above the prior weekly high, PWH,
What?
or below the prior weekly low, PWL.
Ah, okay. So big candle A&D extreme location relative to the week.
Yes. The thinking is, the above average size combined with that extreme weekly location, that's a high probability sign of exhaustion. Maximum reach.
So the PWH and PWL act like magnets, maybe, and provide context. Prices outside the main weekly range, it just spiked hard, potentially trapping breakout traders again. And now we treat that big ATR candle as our new range candle.
You've got it. That large ATR candle becomes the range. The whole point is to catch the snapback, the move back into the weekly range.
And the entry mechanism, is it the same?
Very similar to the 3x3. You wait for price to maybe poke slightly beyond the high or low of that big ATR candle, the false breakout, and then you need that 5-minute money candle to close back inside the range of the ATR candle.
Okay, confirmation again. And the goal is trading back towards?
The middle of that big ATR candle, typically, that's usually the take profit target. Often offers, 50 plus pips potentially. Might take a bit longer, maybe 2 to 4 days for the full move back into the range to play out sometimes.
Right, so it's a great example of using multiple filters, weekly levels, ATR size, the CRT entry, to try and boost the probability. It's more than just basic price action.
Definitely.
Okay, what about the third pattern? The 3x3 continuation trade. I guess this is for when the reversal has happened, and now you want to jump on board the new trend.
That's exactly it. Let's say you had the exhaustion move, maybe 3 candles down, then 1 or 2 candles back up, showing the reversal. Now you're trying to get back in, going with that new upward momentum. They sometimes call it trading on day 2.
Day 2 of the new move.
Yeah. But the sources are quite cautious here. They explicitly say these continuation entries are not guaranteed. You are, after all, chasing momentum a bit.
Which can be tricky. So where would you look for a higher probability entry point for one of these continuations?
They suggest a couple of key areas. First, look for potential re-entry trades around the daily open price for that day.
The daily open?
Yeah.
Okay, why there?
It often acts as a sort of psychological anchor or pivot point for the day. If the new trend is truly strong, price might pull back towards the daily open, find support or resistance there, and then continue. So entering near the daily open in the direction of the new trend can work well.
Okay, daily open, what's the second spot?
They also mention looking for fair value gaps, or FVGs, on the 5-minute chart.
FVG is those price imbalances.
Right. If the new trend is valid, price might retrace back into one of these small gaps left behind on the 5-minute chart. The idea is that momentum should resume from there. So these FVGs can offer quite precise, low-risk spots to rejoin the flow.
Got it. So 3 distinct setups. The core reversal, the ATR momentum trap using weekly context, and the continuation entry trying to catch day 2. That gives traders a few specific things to wait for. But as we said earlier, a great setup is only half the story. The source material really hammers home that risk management is like job number 1. And this leads us to what they call the art of the pyramid.
Yes, pyramiding. This is absolutely key to making the whole thing work profitably over the long run, according to these sources. It fundamentally flips how most amateurs think about risk.
How so?
Well, pyramiding is simply adding to a trade that's already winning. It's the strategic opposite of what many losing traders do, which is averaging down.
Right. Adding more money to a losing position, hoping it comes back.
Exactly, which can be absolutely devastating when it doesn't work out.
Yeah.
Pyramiding is about pressing your winners, not reinforcing your losers.
That makes a lot of sense conceptually. If you're wrong, be wrong small. If you're right, you need to maximize it.
Precisely. And this starts with the very first entry. They call it the tester position.
Tester.
Yeah, the initial entry is always small. It's purely used to check your bias, to see if the market confirms your idea. If that first trade loses and the sources are clear, many will lose. The loss must be kept tiny.
How tiny?
The examples cited were like $10 or $15 losses. It's the cost of getting information, basically. The price you pay to see if your setup is valid right now.
Okay, a very small initial risk. But then the source material adds this really interesting layer. It says the market has to earn any subsequent entries. You don't just pile in. How does the market earn more of your capital?
By moving in your favor. There's a strict rule. You only add to a long position as the price is rising. You only add to a short position as the price is falling.
So you never add if it's pulling back against you?
Never. You stack the additional positions, maybe closer together on the 5-minute chart as the trade moves further into profit, but only as it proves you right. You're essentially using the market's money, your unrealized profit, to fund the increased size, not digging deeper into your own account margin on hope.
Wow, okay. That completely shifts the focus, doesn't it? It's not about being right most of the time anymore. It's about being right big.
Absolutely. That's the core philosophy of pyramiding here. Maximize the reward on your winning trade so massively that it just completely swamps the inevitable small losses from the testers or failed setups.
Is there an example of how this plays out?
Yeah, there was a hypothetical illustration that really makes the point.
Yeah.
Imagine a trader takes 9 trades in total using this system. They lose 6 of them.
6 out of 9. That's only a 33% win rate. It sounds terrible.
It does, on the surface. But because the 3 trades they did win were successfully pyramided, adding size as they worked, the total net profit was still significant. I think the example showed $290 net profit. The few big wins totally overwhelmed the many small losses.
So the message is winning frequency doesn't matter as much as winning magnitude.
Exactly. When you win, you must win big relative to your initial risk. The strategy pushes for aiming for maybe a 1-to-4, 1-to-5 risk-to-reward ratio per position within the pyramid. This ensures the math works out, making your overall profitability less dependent on having a super high win rate.
Which psychologically must be tough.
Oh, definitely. It's probably the hardest part. Most people want to be right often, even if the wins are small. This system demands the opposite. Accept lots of small, manageable losses without blinking, and then have the conviction to press your advantage aggressively when a trade really takes off. Be a lion when you're right.
Okay, so let's try and tie this all together. What does it mean when we combine these 3 pillars, the setups and the risk management? This deep dive seems to show that consistent trading, at least according to these sources, isn't about guessing or complex indicators. It's about a unified system, discipline, context, and capitalization.
That's a good way to put it. The discipline is having the patience to wait only for that specific 3x3 pattern, seeing the required speed and decisiveness that suggests potential exhaustion.
Right.
The context comes from using those weekly extremes, the prior weekly high and low, as that critical filter, especially for the ATR exhaustion trades, to confirm the reversal trap is happening at a meaningful location.
And the capitalization that's mastering the risk through pyramiding.
Yeah, making sure you never risk too much on just checking your initial idea, but being ready to capitalize aggressively, ruthlessly even, when the market proves you right. That's what allows you to potentially sustain a lower win rate, but still be highly profitable.
The implication here, though, is that this demands incredible discipline, almost painful patience.
It really does. It means you have to accept that, most currency pairs on most days are just not worth trading. You have to sit and wait for your specific conditions.
So the time spent not trading is as valuable as the execution.
Just as valuable, maybe more so. And if a trade fails, especially quickly, it often just means you were trying to fight the bigger underlying trend. So risk control, cutting those losses small, has to be absolutely paramount. Always.
It really reframes things. So here's something to think about. If you can set up your process, your methodology, so that you can actually lose, say, 6 out of every 9 attempts, but still walk away with a significant net profit. How does that change the way you think about success and failure? Not just in trading, but maybe in any high-stakes field where knowledge and execution matter.
That's a powerful thought.
Definitely something to chew on. That's our deep dive for today. We'll see